Welcome to Friday Takeaway. This week I look at two clothing stocks, namely Magni-Tech and Padini, where their share prices have gone in two very different directions. But we start with the fact that financial markets have been rallying thanks to US President Donald Trump, who is considering pushing back the deadline for the imposition of higher tariffs on Chinese imports by as much as 60 days, according to sources who told the Wall Street Journal. March the 1st was the original deadline for more than doubling tariffs on $200 billion of Chinese goods. But that date could slide if China and the US inch closer to a deal that addresses deep structural changes to China's economic policies. US Trade Representative Robert Lighthizer and Treasury Secretary Steven Mnuchin are in Beijing this week for the latest round of high-level talks with Chinese Vice Premier Liu He, and the meeting between Lighthizer and Chinese President Xi Jinping is also scheduled for this week. Trump's willingness to extend the deadline apparently hinges on the outcome of that meeting. Malaysia's economy grew by 4.7% in Q4. Bank Negara Governor Datuk Noor Shamsia said private sector activity remained the main growth driver. Services also grew thanks to continued strength in consumer spending, particularly in retail. Total growth for 2018 came in at also 4.7%, according to Bank Negara. Manufacturing was driven by electronics and electrical and consumer-related clusters, while commodities continue to recover from production disruptions, experienced since the second quarter with higher growth in mining and agriculture. Headline inflation, moderate at 0.3% as transport inflation turned negative. She also added that zeroizing GST and the implementation of SST squeezed headline inflation. In this week's This or That, I look at two clothing stocks. Penang-based Magni-Tech Industries is a garment maker, making clothes on behalf of other people, mainly Nike. They go against Padini Holdings, which was once a garment maker for other people, but have since branched out into their own stable of brands today. Their recent share prices have not moved in the same direction, and likewise, their business outlooks also diverge widely. So let's size them up. With a market value of around 720 million ringgit, Magni-Tech is controlled and managed by the low-key father-son team of Tan Sri Dato Sri Tan Kok Peng and his son Tan Poi Seng. Magni was initially involved in packaging before later diversifying into apparel, which today accounts for 90% of revenue. Magni's garment business is undertaken by its subsidiary, South Island Garment, which operates both here and in Vietnam. A major client, Nike, which accounts for some 90% of the annual production. Both Magni's key business segments of garments and packaging grew in the last reported second quarter, and therefore so did headline net profit. But the main kicker for Magni is the planned capacity expansion. Its new Plant 1 commenced operations in March last year, while its new Plant 2 is currently under construction and is expected to kick off in mid this year. A couple months ago, Public Investment Research noted the stock had slipped close to its 12-month low, making it relatively cheap at just single-digit PEs, which they said made Magni attractive. That's caused a net cash of 230 million ringgit. Its cash holdings was already over a third of its market value. And then when you combine that with the undemanding valuation and attractive dividend yields of around 5%, there will seem to be little risk for investors to ride on its coming earnings improvement. As a manufacturing concern, labour costs matter a great deal in both Malaysia and Vietnam, where their factories sit. These costs have risen substantially over the last few quarters, with another increase taking effect here in Malaysia starting 1st of January. Plus, material costs are rising and garment revenue growth is quite muted. Other possible risks? They include demand volatility for affordable sportswear, a weaker US dollar, which has actually happened in the last few weeks and will result in reduced currency translation of sales and profits. And of course, any sharp slowdown in the general level of activity in the major economies. I noticed only one analyst who covers Magni on Bursa Marketplace. That person's call is a strong buy, with a consensus target price of 6 ringgit 45 cents, which means there's a potential gain of about 46% of the stock if you buy at around the current levels of where the stock is at the moment. Padini began life humbly. Like Magni-Tech, Padini started in garment making and trading for retailers and distributors, before later venturing into distribution and retail by creating their own brands catering to specific consumer niches. Today, Padini is 3 times the market value of Magni-Tech at around 2.2 billion ringgit, and they've got 9 labels in its family of brands and retail and a combined 330 stores worldwide. Unlike Magni, analysts say Padini's near-term outlook is challenging, mainly on weakening revenue growth and high costs at its newer stores. First quarter earnings were dragged by steeper store costs, slower than expected sales performance, and worsened by flat same-store sales growth. Analysts also think new store operating costs could stay high, which could be challenging with its large base of 102 stores in Malaysia. With caution entering the market, fashion is expected to remain competitive as consumers pool spending on discretionary items like apparel and clothing. With this, there could be also margin pressure due to two things. First, a lack of clarity on cost impact of sales and service tax, since Padini's inventory was mainly sourced before SST's implementation. The second reason, price pressure from its suppliers, as most textile articles, or in layman's terms clothing, falls under the 10% SST bracket. Padini remains a well-known fast fashion retailer in Malaysia that competes with H&M and Uniqlo, and that's something for them to be proud of. And because they target the low to middle income groups, their merchandise remains fairly affordable. With all year-round promotions, sales volumes remain high and therefore cash flow remains strong. With Padini trimming new outlet store openings just for this year, capex spending remains benign. Moreover, and meanwhile, they're also considering closing several underperforming stores within the next 1 or 2 years, which in turn would ease its high store OPEX. Of the 12 analysts who cover Padini according to Bursa Marketplace, only one is a strong buy, none are a buy, 6 are a hold, and 5 are either a reduce or sell. With a consensus target price of 4 ringgit 52 cents, there is a potential gain of about 33% if you buy it around what the current levels are.